and welcome to the second episode of The Rent Roll, your podcast on all things rental housing, talking multifamily apartments, single-family rentals, build to rent, talking policy issues, operational issues, investments, the whole gamut. This episode is sponsored by Madera Residential. Check it out at maderaresidential.com. Today's episode, we're talking a lot about apartment topics, but for all my SFR friends, don't worry, we'll be covering SFR more in the future. We're going to be talking to my friend Dan Oberste, the CEO at BSR REIT, based in Arkansas. I'm very active in the Sun Belt. And I'll be talking to Dan about myths. There's a lot of myths around apartments. We're talking myths around the Sun Belt, myths and challenges of being publicly traded, myths around affordability topics, very nuanced topic that tends to get painted in one broad brush. So that'll be a fun conversation with Dan. And as always, we're going to dive into some other topics as well. I'll be showing you some research I've been working on. We'll do some rental housing trivia, nerd out with a little trivia stuff for your for hopefully a little bit of nerdy enjoyment. And cover some feedback I've been getting, questions as well as complaints, and some topics in the news as well. So we're going to have some fun today. And let's get right into it. We're going to start off with some research around affordability, and this will tease into my conversation with Dan. So here's a chart. Actually got a couple of them for you. The first one is wage growth, tops apartment rent growth for 20th straight month. And this is an important one because if you go back to 21, 22, as you can see, the blue bar over the green bar, that means, or line, I should say, we had a lot more rent growth than wage growth back then. And that big hump. And so that was put a negative headwind toward affordability. But it's dramatically changed since then. We've added a lot of supply, apartment construction at 50-year highs. That's putting downward pressure on rents, even with significant demand, especially this year. But what's happened is, while wage growth is moderated to some degree, it's still quite strong in the big picture, especially for those younger adults who are key to the apartment, key apartment demographic. Our median apartment renter age is 31, and wage growth has been stronger of late among younger workers than among older workers. That's a good apartment tailwind as well. So 20 straight months where wage growth has surpassed rent growth. And I think by the end of this year, as this trend continues, we're going to erase the entirety of that hump that was created in 21 and 22. So that's a great thing for both renters and for investors because we're widening the demand funnel for who can rent and market rate apartments. And this will tie into the second chart here, which is showing you the median rent income ratio among new lease signers and market rate professionally managed apartments. This is taking actual data for applications on household incomes as well as the rent that they're actually signing for. It's just limited to the new lease side. Okay, that's where we get the income data. And what you can see is that after peaking at 24% in late 2021, early 2022, it's come down with all that supply, and again, wages growing faster than rents are now around 22% again. So this is a good trend. Now remember, if we look at professionally managed market rate apartments, these are generally catering more toward your middle and upper income renters. Also remember that you have roommates that oftentimes are sharing the rent burden, so you could have two 25-year-olds with $55,000 incomes each, together $110,000. That's what makes these rent income ratios lower than you might expect to see. But also, again, remember the demographic we're dealing with in this part of the market tends to be a bit more affluent. So overall, though, good story on affordability. I think we're entering a cycle now where affordability is more of a tailwind again than a headwind for market rate apartment operators. And same could be true for SFR as well. Now let's move into rental housing trivia. This is where I give you some good tidbits for next time you're at the bar trying to make conversation with your friends. Say a little bit tongue-in-cheek, of course. Today's question is, CMBS and other non-agency asset-backed securities represent what share of total U.S. multifamily debt? There's more than $2 trillion in multifamily debt. What share is CMBS and ABS? Is it A, 3%, B, 6%, C, 12%, or D, 24%? All right, so think what that might be in your mind, and we're going to revisit this in a little bit. But first, in the news, we'll cover some headlines, a couple for you today. First one is actually, I was surprised to see this one. This is in Washington, D.C. from BizNow. Council Chairman Mendelson says, headline, D.C. must stop strangling housing providers by preventing evictions. And I like that he actually said housing providers, not landlords, which is a rather antiquated term. And it shows, I think, more of a partnering approach than a finger-pointing one. So Let me read a couple things from this article. Basically, the chairman of the council is saying that he wants to reform DC's emergency rental assistance program. It says that industry leaders say it's been abused by tenants to delay eviction proceedings while not paying rent. So obviously it's important to protect those at risk, but also important to prevent abuse of protections for those who don't actually need it. And a quote from the chairman says, "I'm not surprised by opposition to his proposal because the idea of eviction is not a desirable goal. However, we are not going to improve the housing situation in this city if we are strangling the provider market by preventing evictions. There has to be some adjustment toward the middle." Continuing his quote, "That middle is, yes, we help folks who need rental assistance, but at the same time, we don't require that essentially the burden be carried by housing providers." And again, I'll emphasize the affordable housing providers to carry more and more debt. So really surprised and encouraged to see this conversation happening in Washington, D.C. Now, still has to see this actually get voted on and passed, but it's an encouraging step. There's been real challenges, particularly in urban coastal cities where the pendulum has shifted so far that it's made it very difficult for apartment operators and SFR operators to operate in those cities. And hopefully we see some balance restored where we can protect those at risk while also protecting against fraud. So hopefully we can see that move forward. Second headline. This one is from LA. It's in urbanized Los Angeles. The headline is Costco anchor development at 5035 Coliseum Street breaks ground. Thrive Living project will feature 800 upstairs apartments. And this one's pretty cool. Apartments on top of a Costco. You see this map behind me. This is in Los Angeles. We're trying to make a regular feature of this, trying to feature a cool project happening across the country. We'll make this our first one. Costco and 800 apartments. It's also going to include 100 something, close to 200 low-income affordable housing units, which obviously that's a win, having a mixed income community here. And so we love seeing this type of density where you have obviously a really massive retail anchor, but being able to include much needed apartments in a city that needs more quality housing on top of it. So great to see this one here. And we've included a picture for you to see, a rendering, I should say, of what that's going to look like. Pretty cool project. Next topic, good question. This is where you're going to highlight a question that I'm getting over social media or elsewhere. Today's question's around rates. The Fed has just lowered the base rate by 50 bips. What does that mean for apartment deal flows and cap rates? Well, we'll see. But one thing I want to point out is that you look at transaction activity that's already occurred this year, a lot of investors, a lot of buyers, they've already priced in some rate reduction, right? And this Fed's been signaling that they'd be cutting rates for a while now. It's finally happened. Probably took a little longer than most folks wanted to see it take. But I think we've already seen some cap rate compression this year. So I think that's pretty much priced in, especially for your more Class A, well-located apartments. And so I think now maybe we see a little more deal flow, hopefully start to pick up a little bit. I think the next question is, do investors start to kind of price in the next cuts? The first one's probably already priced in. And so we start pricing in the next ones. And I think you could argue we'll see a little more cap rate compression, again, especially for well-located Class A real estate. I still think we're going to see some spreads larger than the past cycle between A to C. But again, this is a good signal in the right direction. I think it's most importantly, it's a important symbolism of where the Fed is in terms of its fiscal policy and showing that, hey, we're not raising anymore. In fact, we're now moving in the opposite direction. That's a good thing for investors. And next thing, the complaints department. This is where I get addressed some complaints that I get. And today's actually relates to the affordability charts that I shared earlier. I got a comment on LinkedIn. It says, homes and apartments go unbought and unrented since wages are too low. Wages have not risen the same as other costs of living. That is the root of the housing crisis. Housing is unaffordable since citizens cannot afford housing. All right. So I get forms of this question all the time. And so I want to try to answer this one. First and foremost, I think it's important to realize that there's affordability is bifurcated, right? And so homes and apartments are not going unrented and unbought. We don't have massive vacancy across the country. We have actually fairly low vacancy. And so what's happening is that there's been ample demand. Let me speak specifically to rentals. There's been ample demand for apartments and single-family rentals at today's rents. But at the same time, we also have millions of households who can't afford that. And so, yes, it's true that on the overall story, wages have not kept up with home prices especially, and I talked about this earlier, but especially in 21, 22, wages didn't keep up with rents. But a segment of the population still been able to afford that comfortably. And so the demand is there, but that doesn't solve the need for those who haven't been able to afford today's market rates. So the two things can be true at the same time. Talked about that a little more in the last episode as well, but this is an important topic that's a little more nuanced than sometimes it's painted to be. Now let's go back to our rental housing trivia. The question was, CMBS and other non-agency asset-backed securities represent what share of total U.S. multifamily debt? And we gave you 4 choices here, 3, 6, 12, or 24%. And the correct answer is 3%, just 3%. So this one makes apartments a little bit different from other commercial real estate. Obviously, apartments have Fannie and Freddie together. That, as well as some federal financing, represent about half of all U.S. multifamily debt. Banks and life insurance companies, other lenders represent the balance of the rest, most of the rest of that balance, and only about 3% is CMBS. And so this is a higher risk tranche of the debt market. And so a lot of headlines talking about rising default rates and risk in multifamily. A lot of times, when you dive into the details, it's really about CMBS or CLOs. Again, these are small slivers of the debt market in the big picture, important, but still higher risk, smaller tranches. And so only 3% in multifamily, which is obviously much less than it is for office or retail and industrial. Now we're going to move into the interview, and I'm going to be able to talk to my good friend, Dan Oberste, CEO of BSR REIT. All right, now we move into the interview segment of today's podcast, and I am super pleased that we have my friend Dan Oberste, the CEO of BSR REIT, coming to us from Little Rock, Arkansas. Dan, thanks so much for being here.
Thanks for including us. Anytime, anything for you, Jay.
I appreciate that. So, as many of you know, BSR, publicly traded apartment REIT, and Dan, the REITs tend to for the broader market, they represent the apartment sector, but obviously very little of the apartment sector is actually publicly held. So tell us a little about the good and bad of being a publicly traded apartment REIT.
Yeah, that's interesting. I mean, the public REIT is kind of like a dodo bird in the real estate ownership world. I mean, in the United States, the public REITs really own roughly 15% of the total product in any sector. And a bit of that has to do with the United States capital markets. I mean, the public stocks, those public REITs are huge and massive. And so in order to be public in the United States, you've got to be huge and massive. And a lot of people that own real estate, nobody starts off huge and massive. You build your business over time. So I think what we've seen in the U.S. is this small percentage of massive, and in some cases diversified public REITs that own, let's say it's 30 or 40 shops. I think, 144 public REITs in the United States? They might own 10 to 15% of the total office buildings or apartments or retail anchored grocery stores that are available in the market. The rest are owned by private institutions or you and me, Jay, or mom and pop. It's been an interesting endeavor. When we first started thinking about going public, we owned at that time about 125 assets sprinkled across the Sun Belt. And the U.S. market was just not, it wants to see a $10 billion REIT or an $11 billion REIT. I think that's the average market cap for a U.S. public. There's not a lot of $11 billion real estate owners in the class. That U.S. market also wants to see some homogeny, and they want to see you own safe, comfortable investments, right? Class A office buildings in New York or apartments in London, or something that makes sense in a sentence. But as real estate investors, oftentimes you're able to, if you're putting your own money to work, you might find that the best real estate investment in the world is a grocery anchored retail center in Ohio, right? So I think what we found is there are some other exchanges that allowed us to build a company, or was build an aircraft carrier while on the water, so to speak. Canada was one of those. So we IPO'd in Canada 2019, I think. It's been a good experience. It helped us build a business when I don't think being in the U.S. would have helped us.
Yeah. Yeah, and y'all have a unique model, but it kind of gets me thinking about something that I've been passionate about in some of my research. One of the things that makes me love what I do is that there's so many myths and misconceptions, misperceptions of apartments from what people think versus what's happening in reality. And let's start with one of them, just on valuation side. I always get a little bit of a kick out of the how the Wall Street values REITs versus how the private market values individual assets. And I know that's something you spoke about on your last earnings call. So could you talk to us a little about how you think about that, the NAVs versus kind of real life street values?
Well, sure. But first, I'd say, Jay, when you think about making a real estate investment, how do you value it? Do you say, I'm going to buy this house for $100,000, and you know what, it's going to be worth $400,000 next year? Or do you say, I'm going to buy it for 100, I'm going to rent it out, make 15 a year for the rest of my life? And how do you think about it, Jay?
Yeah, well, obviously, I would start with the comps and whatnot and see what it's really worth, and then I don't want to assume super future valuation, but I would be much more interested in what similar properties are trading for.
Yeah, I think the issue that we got into, you can blame 0% interest rates for this, or you can blame the FANG stocks, or you can blame a lot of factors. But I think people started viewing real estate stocks as parabolic. That if I buy Simon Malls or Camden or MAA or Avalon Bay, I buy it today for 100, it's going to look just like Tesla. It's going to be worth 300 tomorrow, right? I'm going to get in and get out and make. But the reality of real estate ownership is not parabolic. It's a compound annual snowball cash flow growing machine. It's what Warren Buffett and his partners talk about, that the human being just doesn't understand what compound annual growth means. They can't comprehend what 3.5% or 6% or 7% per year compounded does over a very short period of time. So what you ended up having, I think, in probably 2016 through 22, is you had, some say REITs were priced for perfection, but in my view, they were underwritten by the public markets as parabolic. And it makes sense, because if you're a REIT stock or a real estate company stock is compared to Tesla. It's a product for a consumer that they can invest in. And their comparison is another company, Facebook, Apple, Netflix, Tesla, you name it, right? And if the market is willing to pay a 1,600-year multiple for a share of Tesla stock, then in order to compete, you've got to be able to sell that real estate stock for a 50 multiple, 100, whatever the multiple is for the real estate stock, right? And it creates a kind of an irrational valuation gap for a business that's just designed to really, truly, Jay, hand the ball off to the fullback, get 4 yards of carry. After 3 plays, you got a first down. After 7 plays, you got a touchdown. Wash, rinse, and repeat. Stop the other guy, and you win, more than you lose, right? That's real estate buying, how we all value real estate. To your point, we don't think about reversion value. We say, how much is it worth today, and what are the comps? Now, how much money am I going to make per day for the period of ownership? And you know what? 20 years from now, when I sell the asset, it's probably going to be worth more, but I don't know how much more. I'm focused on the cash flow, right? So you get into, you talk about the people that own 15% of the product, these public REITs. I think they were priced at a fair value. A 28 multiple, a 30 multiple, in the midst of a stock market that was on average, I think the S&P at the time was traded at a 37 multiple. Now, I'm a little bit biased, but as a real estate owner, I'd rather own my real estate at a 30 multiple than a share of a stock at a 40 multiple that doesn't produce cash flow, right? Yeah. That you're kind of betting on the come. But I'm not everybody. So I think what you had is you had a bunch of bets on FANG stocks on the come. Some of them are producing, right, actual money. And then you had these real estate investments that were coming along for the ride. But operationally, they're just generating compound annual cash flow growth, right? So what have we seen since 22? We've seen in the public markets, the real estate stock values crater, pull back. Now, you could say, I know your question was good and bad. I think what we saw and what a lot of similar operators saw is we saw a bit of an arbitrage opportunity to issue stock at a higher price, which you can do in the public markets. It's instant access to, at times, the lowest cost of capital on the face of the planet that enables you to buy whatever you want, right? And you got to make the good investment decision. Now, on the way down, if you're an operator, if you're Rick Campo, if you're Ben Shaw, you know precisely how much your assets are worth.
Yeah.
And the stock market, the stock price never reflects precisely. It either over reflects or under reflects. And on the way down, as a public company, we could walk in to the markets and we could say, okay, our stock's traded at $12. Yeah, we'll buy back, $70 million worth of stock at $12 because our assets are worth a hell of a lot more than $12. Now, in the private market, you think of it as the mark to market on stock prices is bad. It's actually good, right? When you're as an operator, you're trying to identify arbitrage, something's either overvalued or undervalued, and you're trying to make that spread in the middle, and that's why your investors hire you, right? So what you saw a bunch of the public guys do or the public investors do or the operators that had the balance sheet, is they started buying back their stock in droves on the way down, right? And 2 years from now, people will look back at that and go, y'all are geniuses. What great capital allocation decisions. But while you're doing it, nobody's very happy, right? Now, that is a good thing about being a public company. You have instant access to capital, so you're never going to go bankrupt, right? In theory, so long as your product's good. You might have to dilute your shareholders, but you're all right. Now compare that to a private investor. So Jay, let's say you and I put together a deal in 2020. We're building some apartments. How about that? And man, we're pricing them at a 3 cap on reversion. We're going to earn our promo, buddy. We are going to be rolling in it, right? We raise some money from investors, right? Who drink our Kool-Aid. They believe in what we're doing. The product's great. Of course it's going to sell. Come on, this is going to sell, right? For a high price. Now, what those syndicated deals, those LPs, they haven't gotten the benefit of a mark to market. Every single minute of every single day, our investors can see how much their equity is worth in BSR at that day, right? Same for Camden, same for MAA, right? And look, we get complaints when the stock price is down, and we never get attaboys when the stock price is up because it can never be high enough, right?
Yeah.
But what we don't get is silence for a 3-year period as our equity value erodes. So in that example, you and I put the deal together, man, and our investors don't know that their capital is worth 20% or 0% of what they put in 2020. They don't know until the fourth quarter of 24 or 2025 when we actually sell the asset that we have to sell, right?
Yeah.
Because we don't have permanent access to capital. We got to refi the bank debt. We can't take the loan at a 300 spread from First United Bank of, Collierville and push it over to JP Morgan. The public REIT can't, right? And so I think the setup on a look forward is that public REIT, every cycle there's an aggregator. I think we saw B REIT and S REIT, a handful of these non-traded REITs, highly levered mechanisms. We saw them blow up and get huge in 2016 to 2020. A lot of us don't remember GE Capital, being on both sides of that debt and equity trade in 96 to 2010. And we don't remember them because they don't exist anymore, right? And then maybe before that, it's Trammell Crow, who's still a fantastic company, but they were the Boston Celtics of the 70s for about 15 years. They were the perennial behemoth, right?
Yeah.
I think there is a setup for the next 10 years for the well-capitalized REIT to borrow against short-term rates and to buy on the long end of the curve a cap rate spread that is double what I think I've been able and you've been able to experience in your career, in our careers.
Good. Yeah. And I'm a both and guy. I think there's a good case for both. And, I now that I'm on the private sector side, I will say that it's not nice having the irrationality of things that are way outside your control affecting values, but you make a very strong case for investing in REITs as well. So Dan, on the topic of MIST, there's a lot more we can talk about this, but one of the things that you and I share a passion around, I know, is the myths around renters. And so, I talk about this a lot. I think affordability is a very bifurcated issue. We have a shortage of affordable housing. At the same time, there's been enormous depth of demand for market rate apartments at today's prices. So first and foremost, I'd like to get your thoughts on that. So tell us about kind of the perceptions versus what you're seeing in your portfolio around things like rent collections and rent income ratios.
Yeah, well, you think about a myth, right? I think people are worried about, and during COVID, they were worried about collection of rents, right? And I think what we saw is the Midwestern operators and the Sunbelt operators had no problem collecting rent. The higher, I would say the coastal and the urban operators, so in Manhattan and otherwise, they had a real problem collecting rent. I mean, not only were they collecting 90 cents on the dollar or 80 cents on the dollar of rent, but they lived in these regimes that allowed residents to stay in their product for a period of years and not be evicted and not have to pay back the rent. Well, I mean, I'm aside from the societal need for that and any comment on politics, when you think about just running a business, you can't run a business when someone drinks your soda but they don't pay for it, right? You can't continue to, right? So we didn't see that in the Midwest. We didn't see that in Minnesota. We didn't see that in Texas. We didn't see that in Florida or Georgia or Tennessee. And, Rick Campo does a good job describing this. He says that the mindset of the consumer in those markets is a mindset of, I pay my bills, I don't take out obligations that I cannot repay, right? I think that's probably half of it. But I think the other half is that, and you've written about this, man. I mean, the rent in Minneapolis is 20% of the median income, right? So what does that do? When you and I are paying 20% of our paycheck to rent, we've got 80% of our paycheck to buy iPhones, go out to movies, support the micro economy, which then creates a bigger economy, right? And creates a little micro GDP growth. So you end up creating this society where, to me, it's like the tale of two cities right now in America. You have the best of times. You have this generational migration flowing into towns that we call the flyover states when we were kids, right? Away from these unaffordable markets. So the myth is collections are a problem. They weren't a problem for Center Space. They weren't a problem for an investor that owned apartments in Denver. They weren't a problem for someone, an apartment operator or a movie operator in Nashville. They were a significant problem for someone who owned a concentration of assets in New York or Los Angeles or Portland or Seattle, right? That was a myth for certain operators and a reality for others, right? I think when we think about the focus on affordability now, we've seen a lot of these public reporters come out and talk about their rent to income in the last quarter. I know you wrote about some of it, and every single one of them kind of hits you over the head with it. And I'm thinking about a handful of coastals that reported a 17% rent to median income ratio. Well, I call that a myth, Jay. I think the 17% is when you got mom and dad guaranteeing the lease and you as a tenant on the lease, and you add up all those incomes and the rent's 17% of the incomes. I don't think, when I look at the average apartment rent in Manhattan, for example, at, I don't know, $4,500 a month, I don't think the average person in Manhattan is making $250,000 a year or $300,000 a year, right? So there's a myth going on in the market right now that these unaffordable markets, that it's not their fault. I mean, they're burdened by tax regime issues. I mean, you just saw it in New York. New York wants to drop another $54 billion in consumer-funded debt on specifically its subways and infrastructure. That's just going to make it more unaffordable to live in New York. It's not going to make it more affordable, right? So that's adding fuel to the fire. Now you compare that. I'd love to be a homer for Texas. We can compare it to any of the towns in Texas, but compare it to Nashville is a great example. Nashville has got an infrastructural advantage, right? And it doesn't need to saddle $70 billion of debt on its taxpayers to fund its highways. That's already done, right? So you have these, I'll say, newly developed markets that just have a critical and undisputed advantage that we've seen. When the rents get too high, what do? They build more units, right? Because land scarcity is a bias, not a reality, right? They build more units. The influx of units pushes down rent growth, and the consumer still gets to buy or rent their apartment at an affordable price relative to their paycheck. And as a result, the MSA continues to thrive, right? That's a reality. The myth is that if I live in Manhattan right now, I'm paying 60 cents on the dollar in taxes, whether it's to the city, to the the region, to the state, to the federal government. The myth is that I can continue to survive over the long term with that tax regime in place, right? It's just not gonna. We're gonna see these Western cities, these new cities, become the largest population centers in the country over the course of the next 30 years. It's going to be generational, but it's not stopping, right?
Well, and the other thing too, Dan, as you know, is that when you think about myths versus realities, I'd kind of add some nuance on the affordability side. Is that I'm sure the same in your portfolio. Is that in most of these institutional grade apartments, REITs or otherwise, this is not your, I would say, average renter household from census data reflecting like who's living in these apartments. These are generally middle and upper income renter households who live in this. Could be roommates, two 26-year-old guys making $55,000 each. They together have a pretty good household income where they can afford that rent, and that's helping keep those ratios down and keeping the rent in a territory they can afford.
You're right on. I mean, I think we've forgotten 0% interest rates allow us all to renovate our homes, right? And they allow us apartment developers to put granite countertops in and drop down make these beautiful products. But let's not forget that the product is a temporary residence. It's an apartment. It's if just because 0% interest rate exists doesn't mean that your Pepsi should now be considered a bottle of Veuve. It's a Pepsi, right? And there's a price point for that Pepsi, right? And so we have the benefit to the consumer, I think, between 18, I think of it like vintages of wine, Jay. I mean, that vintage of apartment between, 15 and 22, 23, that vintage was funded by 0% rates. So that developer could build the best product on the market, right? Now you've seen regimes where we have high interest rates, and you see you walk through the product and you go, okay, I can see where they cut corners here and there. It's because, you can't afford to put quality in when you're paying a lot of money in interest costs, right?
Yeah.
But the product has to be built. That's a bad vintage apartment, right? What the consumer has been able to experience right now is a fantastic vintage construction in Tampa, right? Of a brand new apartment complex with finishes that are better than we can get in our homes, right? So that consumer is not wanting to leave after a year. Maybe they stay a little bit longer. So you're seeing renewals as opposed to 1 out of every 2 residents leaving. Maybe it's like 1 out of every 3 residents are leaving every year. They're staying a little bit longer because the product's nice, right?
Yeah.
The 0% interest rates creates a low price point for the buyer to be able to afford to run a business off of a low rent, right? Now, I think where people can get confused is with construction costs going up and that's something that costs $200,000 a unit to build in 20 may cost $400,000 a unit to build now, right? Well, we can't magically double the rent. It's still a can of Pepsi, right? The consumer does not have, they're not making twice as much. The rent on that more expensive thing, the cost of it is driven by higher interest rates, and the rent on the more expensive thing is still the same as the 2020 product that cost $200,000 to build.
Yeah, and by the way, I mean, even if they can't afford it, which I think a lot of them can, they can get a comparable product for cheaper. And so even if you can afford it, you're going to pick the better deal. I mean, the same thing for you and me. If I get 2 comparable products, I'm going to pick the cheaper one, right?
You would think logically, but it's funny. After 10 years of meeting with investors over and over again, specifically the public fund investors, what I hear a lot is, Dan, great company. I've got this condo that I bought for,
Oh,
$2 million dollars, and I'm going to rent this condo out. And all I
yeah.
can think about is like, do you go to the doctor and the doctor says, you got a heart valve that needs replaced and you go, I'll do it myself. I'll do it myself. No, you pay the doctor to do it. I mean, the benefit of the public model is if we screw it up, we get fired and we get sued, and so you end up having these Navy SEAL type operators that are running these businesses that are the best at what they do, that are well capitalized, and you come to them and you say, I got a condo, I'm renting it out, I can do what you can do. No, you can't. Like, we can do it better and we can do it cheaper, and we can operate it more efficiently. I don't see that in many other industries. I don't think that I can buy a Chick-fil-A or buy a product that looks like Chick-fil-A and make a better chicken sandwich.
Yeah.
I just go buy Chick-fil-A, But
Yeah, and I was talking
really,
about renters who are picking. I mean, they're not going to pay twice as much because the construction costs are more. But yeah, certainly. I mean, this is a very fragmented industry on the operator side, and we've seen some new entrants obviously have not been able to operate well, and that's hurt them. So let's talk about, we're talking all kind of myths here because, Dan, you and I live and breathe this stuff every day. And another one that I know you talk about a lot on your calls is about the Sun Belt. And obviously y'all are invested in the Sun Belt. I've been a believer in the Sun Belt for a while. Tell us a little bit about kind of the myths versus realities in the Sun Belt, and some of the conversations you have with your investors and with the street about kind of what you hear versus what you're trying to educate them on.
Yeah, sure. So the myth is supply, right? It's funny that no matter how smart someone is and how educated someone is, when they think of supply, they think of the number of apartment units being put into a market. Dallas, Texas, 40,000 units, right? Austin, 17,000 units. Houston, 15,000 units. Oh my gosh, look at all those units. And that's going to create a long-term problem for the market, right? But Jay, when you create a batting average, right? In fifth grade, we learn how to divide, or fourth grade. There's a numerator and a denominator, right? We don't just take the numerator and say, look at the numerator is 1,000. That's bad or that's good. You say 1,000 over what, right? And so I think the high focus in the last couple of years has been the gross number of deliveries in a market, or the gross supply amount. And they forget to focus on the net inflow of whether it's intrastate migration or people moving for affordability or just simple birth rate, right? So they forget about the fact that maybe Dallas delivers 40,000 apartments, but it grew in 2020, last year, with the most recent data we have, by 140,000 people, right? And 40% of those people are going to live in an apartment. So just the population growth absorbs 37,000 of those 40,000 apartments. And maybe the 3,000 were needed to keep that market affordable so that it didn't get out of hand, so that it can continue to drive job growth next year and the year after that, and so that it can continue to drive population and taxpayer growth. I think the investor forgets about the population. I think they see the population growth as a show me number. Like, we don't believe it, but we know what the gross deliveries are. Even though historical track records have, you hear about Dallas being an accelerated population growth market during COVID. Well, buddy, what is Dallas County, or the county in Dallas, has been the fastest? It's been one of the top 4 fastest growing counties in the country by decades since 1960.
Yeah, COVID just accelerated a pre-existing trend.
To me, it just got to some critical mass. At 9 million people, are you still going to grow by 2%? Wow, you are? That's insane, right? 250,000 people are going to move into Houston? Wow, that's going to continue? I think all the ingredients are there, and you can just logically point to unaffordability of other markets, air conditioning, technology, AI. You no longer have to live in downtown LA to be a film producer, right? You can live in Dallas, Texas, Nashville. You can live in Nashville and you can make a You can be a world leader in the music industry. You do not have to live in New York, right?
Yeah.
You're seeing people understand the impact of technology on these flyover states that happen to be affordable, right? And that's not going away. That's going to be here forever.
Yeah. No, I mean, to your point, I do this all the time. So people look at rankings. It's like, okay, well, X, say Dallas has the most apartments in the country. That looks like a lot. But, our industry, I think analysts do a really bad job of looking at supply and context, not only demand, but also history, and say, okay, what's absorbable in a typical year? And so, for instance, that's why I think from 2012 to 2022, we saw all these big Sunbelt markets outperform the U.S. averages and the coastal cities in general. Because when they built a lot of supply, it really wasn't that much. Now, and I think you'd probably agree with this, now we're seeing a period where we really are building a lot, and that's putting downward pressure on rents. I don't think these numbers are sustainable on the supply side, though. So that's going to change the calculus here the next couple of years. So Dan, I know I've taken a good bit of your time. Let me ask you one more question, though. As you look ahead, how do you see the supply demand outlook playing out, and when do we start to see rents start to rebound?
Sure. And I'll go back and just for a second. No, Jay, it's probably unfair. I mean, whatever I said about Manhattan, I don't live in Manhattan. I live in Arkansas. I operate in Texas. You live in Texas. The reason people should listen to us about the Sun Belt is because we live here, right? We're seeing it every day, right? I don't live in Manhattan, so I don't know how much an apartment costs in Manhattan right now. Now, conversely, I think the reason the analysts jump all over some of these non-gateway investments is because they don't live there. They live in Manhattan, so they're going to dog everything they don't see and touch and feel, and it's not their fault. What it creates for you and me and our listeners and your listeners is arbitrage. I do not think that something in Texas should be a 6 cap and something in Chicago should be a 4 cap. I can make more money off the growth trajectory in Texas than I can in Chicago. So the thing in Texas should be actually more expensive. I see that. That's fine. Analysts, you guys write what you write all day long because it's creating, it's helping us, guys like you and me, and the people that follow us make a lot more money over the long term. And that is real estate. It's not parabolic. It's compound opportunity, right? It's identifying arbitrage and deploying capital into it. So I'm happy with what they're saying all day long because it creates opportunity for us, right? Now, as far as the future is concerned, I think supply is going to settle down. I mean, we already saw peak absorption and our peak deliveries in Q4 in a lot of these Sunbelt markets, right? Our Q2. Let's be careful though, because it's real estate. These same operators who owned all this product in these markets with peak deliveries, they didn't lose any money. They continued to make money. They made more money. I think we make 30% more cash flow today than we made in 2022 because they got the benefit of renewals and mark-to-markets and maybe taxes lowering because interest rates are going up, right?
It's the lag effect of the rent roll too.
Yeah. So I think at the point of sale, we start to see positive absorption picking up some of these deliveries in these markets as expected in Q4, Q3 right now. But the operational impact will also lag. I don't think, now the delivery cycle's over and we're just going to go back to making 20% NOI gains in a month and Jerome Powell lowered rates by 50 basis points. So now JR 3 cap reversion is going to happen. Nobody. I think what's going to happen is the reality is operational results in real estate will lag expectations. You may think that supply is no longer a problem, and you may think that your NOI is going to grow by 10%, and it's only going to grow by 4%, which is traditionally pretty healthy, right? But it's underwhelming to people because their expectation to keep up that parabolic stock buying or real estate investing is that your cash flow grows by 10 every year. I think we're going to see a little bit of that in the future. And then I'll make a call right now. I think, we're in a tough spot from an interest rate curve standpoint, Jay. I mean, real estate is priced off the 5 and the 10. A cap rate that you hear us talk about all the time is nothing more than some risk premium on top of a 10-year U.S. Treasury, right? Yeah. Well, things are different, right? You got Jerome Powell just dropped rates 50 basis points, and the Fed did, right? And we have a balance sheet problem in the U.S. that We spend 5 or 6 trillion a year. We take in 2.4. So we're going to have to print capital to do that, which is inflationary, right? And if we keep lower, we're not going back to zero rates, because if we do, that is going to be inflationary on the 5 and 10 year end of the curve, right? So either we sit tight at around somewhere between 2.6 and 3.7 as far as a real short-term rate, or we go down to zero. In either case, I think the 5 and the 10 year treasury blows out a bit, right? Just because of balance sheet functions of the government, and tax regime issues in the federal government, right? And here we are with real estate investments that may see, because we're going to have a repricing effect, Jay. Ever since you and I were born, we've said, what's the 10 year? What's the cap rate of this asset? Cap rate needs to be on top of the 10 year, right? I think as we see the 10 year expand, I think the grocery anchored retail cap rate, or the office building, or the apartment complex, or the industrial cap rate, I don't think it flows up as fast as the 5 and the 10 year flows out as we move into a normal curve. And if it does, buddy, watch out, because you've got a ton of capital on the sideline. And if it can get a hold of that short-term rate borrow and end up buying an expanded cap, where we can make a lot of money off this much of a spread between a cap rate and an interest rate, imagine what happens when we can do this, right? It'll be punishing on your NAV cap rates or whatever for your public REITs or your private players. But as real estate investors, we're not trying to create parabolic companies. We're trying to build cash flow growth. You can buy a 7 cap and finance with a 3 constant. 4% levered all day long. I think that's an environment we're walking into. Some subdued cash flow growth, underwhelming because it's lagging, and then a massive cap rate sped on acquisitions.
Hope you're right. Well, Dan, thanks so much for spending part of your day with us. I really appreciate it. I know all our listeners do too. So thanks for being with us.
Anytime, Jay. Thanks for having us.
And that wraps up episode 2 of the Rent Roll podcast. Big thanks again to Dan for joining us. And thank you for all of you for joining today as well. And a big thanks to our sponsor, Madera Residential. Check it out, maderaresidential.com. Thank you again, and enjoy the rest of your day.